So, what's the difference of when you get a gift from someone or you inherit something when they die? And how does it affect your taxes? What will you have to pay taxes on? It all depends on whether they died or whether they gave it to you as a gift. That matters a lot. So, if it's cash, it's easy. You can give up to $16,000 a year, you to as many people as you want every year, 16 grand a year, and there's no tax consequences on you or them. That's the annual gift tax exclusion. So the cash part's easy. If it's a product or a security or something of value, that changes things a little bit. So if I give you a product that I bought for 20 bucks, but it's now worth $50 and you sell it, the taxes you owe on it will be based on if you bought it or I bought it. So if I buy something for 20 and it's now worth 50 and then you sell it for 60, you're going to pay taxes on the amount from 20 up to $60, which is going to be taxes on $40 worth of profit. However, if I bought something for 20 bucks and then I get hit by a falling safe from the sky and I die and you inherit it, you're getting it at the fair market value of when I died. That's called a step up, and it's within 6 months of that date, but you're going to get a higher cost basis. And why that is good, unfortunately I'm dead, but whatever. If you get it at 60 and you sell it at 70, you're only paying taxes on 10 bucks versus all the way from when I bought it. So to recap it, if I buy something for 20 bucks and it goes to 50, if I give it to you as a gift, it's like you got it at 20 bucks, and then if you sell it, you'll pay taxes from my cost basis up. But if I get killed and you inherit it, you're getting it from the price that it is when I died. And that is called the stepped up cost basis. And while you're super sad that I'm dead, you're actually getting a tax break because they're going to use, the IRS is going to say, okay, well, technically you own it at 50 or 60, wherever it is when I die. And then when you sell it, you only pay tax on that amount, not all the way from when I bought it. So if it's like a security or an asset that you would sell for capital gain, this does matter too. There is a difference between long-term capital gains and short-term. Long-term capital gains is when you hold something for more than a year, so then you will pay a lower tax bracket on that, 15 or 20% max. But if it's a short-term gain, which is held for a year or less, you're paying full 20, 25, 30, up to 39% taxes on it. So it matters. If I give it to you as a gift, you're getting it from the day I bought it. So if I owned it for less than a year or a year or less and gave it to you, and then you sell it before it's over a year old, you're going to pay capital gains, but at the ordinary income rate of 39%. But if I get hit by a bus and give it to you, it doesn't matter how long I held it. It's always going to be long-term capital gains. So while I'm dead, you're happy you're paying less taxes. Check me out on YouTube, Capital Advantage Tutoring.